Just to quickly introduce the panel, we're very lucky to have Kapil here today. Kapil is Vice President Legal and Compliance Officer at Harbour West Capital, and he heads the regulatory compliance practice there. And India is part of the coverage for his overall role here. He's joined Harbour West from Ortis Capital Management, where he served as legal counsel and was member of the management committee. And his previous experience includes 6 years as Director of Legal and Compliance at Pacific Harbour Capital, which is a Citigroup affiliate, and known Kapil in his previous roles, and he's always been active on the India front, so we are very lucky to have him. We also have Rajesh, who heads our tax practice at NDA and very active on the fund formation, along with Richie, who heads our fund formation practice. We're supposed to also be joined by William, but he's running a little late. So William Hay is General Counsel at Bearing Equity, Asia Capital. So once he joins, we can get his views too. So Kapil, I'll get you to moderate the panel, please.
Good afternoon, everybody. Is this on? Yes, it is now. All right. Well, thank you for the very insightful opening. William Hay is just joining us, but Mr. Mathur and Mr. Desai, thank you for opening today's session and hosting today's session. PE in India has taken a interesting turn since the market opened. 10 billion on average invested in India. 11 per year, 11 billion US dollars last year. E-commerce and IT, probably the top sector choices. But is this because of political stability or simple rupee depreciation? I think the sense is definitely there's a keen desire by the government to stabilize the local environment, and there's optimism. An 8% growth in funds invested in India in 2014, as well as a 34% growth in funds raised. So those are good numbers, and that's a lot of optimism, but there are many big challenges, and perhaps one of those challenges is exits. Only 30 billion out of the 100 billion invested in 2014, I apologize, since 2005, had successful exits. In light of that, Prabhata, how do you see the current environment for fundraising in India for India-focused funds?
So let me put this a little bit in perspective. For fundraising, for the industry as a whole, it's a very important indicator, and numbers that we track. Being a law firm that's focused on the fund industry as a whole, I mean, that's why we're having the seminar, because we look at it from formation to getting exits for our clients and avoid litigation as far as possible. The formation numbers for us are very important indicators, and so should be for anybody who's interested in this industry in India. And the first quarter for us has been, if that is to be an indicator, very, very good. The number of fund matters that we've already received, double digits, and it's a widespread. We are seeing a lot of onshore as well as offshore fund formation mandates, and the focus of the government to create a fund formation regime onshore, provide for the necessary infrastructure and the regulations, so that, something we've been pushing for a while, that, why should our funds looking at India be sitting offshore, and try and see if we can bring them onshore. And the government, during the downturn of the last 2 to 3 years, actually worked very hard in terms of putting the regulations in place to allow for funds to be based in India. And so for local to local fund raising and investment, where the GPs are, very India-focused and don't necessarily have an international tie-up. We've seen that work increase quite a bit. On the offshore side, we've seen the market to be very more discerning. We are seeing our clients who have the experience already, have successfully deployed money in India, coming back and raising funds successfully. So, compared to the, if we consider this the second round of fundraising for India, the first round was, big names and then breakups from the big names. The second round seems more about experience and more about people who know how to navigate the India market. There's a lot of noise about exits and your capability to show exits. But what we've seen the LPs really value is your capability to actually navigate. They understand the last 2 to 3 years or more were difficult, but your capability to actually navigate that and how you perform and how you chose your investments and how you're performing. They understand the performance might have been bad, but they understand that. They understand if you don't have exits, but experience has been very, very important. The other important change that we have seen from the first round of fundraising is the technical aspects of the fundraise with respect to the LPs are negotiating much more, and I think we're going to discuss it a little more further, but it's not the standard structures we saw previously or the 70-30 straightforward. The LPs are negotiating more as far as India is concerned, and they're looking for more experience in particular sectors. Sector-focused funds is something that we are seeing coming up significantly.
Thank you. Thank you. So people who can navigate the market definitely seems to be a critical element for India. And with that, William Hay, Baring, has just raised a record $4 billion for an Asia-focused fund. Can you share with us the appetite for India and some of the key challenges there?
Well, I have to say we're number 2 behind KKR, so we're not quite at the record yet. We're working on that. India has been a long-term focus of ours. It's been a market that offers an immense amount of possibility historically, but it's been one that has had challenges that have taken, China's had its challenges for 30 years. People pretty much know how to deal with them. I would say that we regional investors are learning how to work the India market. There was an interesting article in the Financial Times the other day that said that in 15 years' time, the middle-class income in India will be larger than that of China. I think the macroeconomic picture is a compelling attraction for investments in India, without a doubt. And the issues that people have often pointed to in currency, government, that sort of thing, these are common to emerging markets generally, and they'll work their way out. I would say that the lesson we've taken is sort of what Kapil was saying. It's learning how to be a specialty investor, learning the particular industries and picking the best one in that sector, rather than going in and sort of doing a shotgun approach. So compared to 5 years ago, I'd say that we've organized ourselves in a very disciplined way into vertical industry segments, and we've made a couple of in 13 and 14, the 2 largest investments that our fund made were both India-related investments that have performed extremely well. So I would say that that our outlook is very positive, and that's our strategy.
Thank you, Will. So revival of the economy and capital market facilitating exits and great optimism. If I could turn to Richie, for a GP fundraising in India, what are the issues? What are the solutions?
Sure.
What is the market today?
Sure. Thanks for the question. I think I'll just keep the focus to the question for any GP who's looking to raise for an India-focused allocation. So which is where we saw a lot of headwinds coming from all directions of the compass. If you're a global fund, with some allocation to India, you can still sell the entire GP brand as such and raise a larger size commitment. But for a GP who's only doing a India-specific allocation, there were a lot of headwinds from all directions. So what we had seen is some of our tier 1 GP clients, they were very engaged with their existing LPs. It's not just limited to, the investor committees or LPACs of the fund, but they had a pretty much a one-on-one relationship with all their key offshore investors so as to not, disenfranchise them from the platform. Accordingly, we saw requests from our clients throughout the year asking us whether sharing this information or particular information on track record or how the fund is doing, etc. Is it something which would not be in violation of the private placement rules in different jurisdictions or not? So we saw a very healthy dose of engagement by the GPs, where they have been pretty much been on the road raising throughout the clock, over the years. It's not just been like if your current fund is, coming closer to its maturity, you have already, let's say, put into place 70% of your, dry powder, etc. It's just like you keep yourself, engaged with the LP. There are several gatekeepers, especially in US. The experience has been that, it's not just a particular individual, but across different leadership, levels and external gatekeepers which are there for a GP to sort of, sell the story. So that was one lesson that we as law firms saw that the GPs were learning. The other aspect was the amount of creativity that came to the fore, especially on the structuring side, was quite appreciable. We saw that the LP appetite was, let's say, on one hand, if you're approaching Mid-East investors, owing to Sharia law or otherwise, they pretty much prefer, let's say, a non-interest but a growth sort of an income return. You have pension funds in US, etc., who like stable returns, less of volatility. And then you, of course, look at India as a growth story, so you would want a higher, carry allocation for the GP. Basically, you would want them to keep a low management fee, but a high carry. So you have a lot of multi-class structures where one class has a different fee carry allocation, the other class is following, let's say, a European style, end of term distribution, another class following American style waterfall, if, let's say, a participant is coming for one particular deal. So we saw a lot of, creativity on the structuring, on the terms being offered. And the experience for Indian GPs on the road has been that, okay, you learn your lessons the tough way, but the vintages have been unkind to the Indian GP, but the lessons have been learned and the proverbial wheat has been separated from the chaff.
Thank you. As indicated earlier, please feel free to interrupt with questions. This is certainly not meant to be a one-way dialogue. So the budget. A lot of expectations were placed on it, and a lot came out of it. I feel that the industry had their voice heard, whether it's GAR or AIFs. There were a lot of good movements, and perhaps, Rajesh, you can share with us the impact of the budget on fundraising for India-focused funds.
Sure. Thanks, Kapil. I think this budget that just came in was really the first full-fledged budget that this government had really come in with. Because last year there was a lot of expectation, but the government had just come into place and there was not enough time for them to really have a full-fledged relook at some of the laws as far as tax is concerned. So this time around, I think they addressed a few major concerns as far as the whole industry was concerned. I think the first big ticket item really that was there was on the general anti-avoidance rules. They were supposed to come into effect from 1st of April 2015. The government decided that this was probably not the prudent time to introduce the general anti-avoidance rules. They pushed it down the road by 2 years to say that the general anti-avoidance rules will only apply from 1st of April 2017. And also what they ensured was that as far as any investments which are made until 31st March 2017, even if the income arises in a post-GAR situation, the rules won't apply to those particular streams of income, which I think from an investor standpoint, you have some degree of comfort when you're going in today, that even if the exit happens 6 years, 7 years down the line, you don't have to worry about these particular rules. The government has also indicated that they're going to have a relook at these provisions because there has been a lot of what I would call concerns raised by the industry as far as the application of these rules, and the government has said that they're going to take a relook at them. I think the second big issue, which at least even on formation side, I see a lot of impact, is on the indirect tax transfer rules. Since 2011, I think you've had this issue going around as to what is India's tax position when there's a sale of shares of an offshore entity whose value is substantially derived from Indian assets. There were retrospective laws that were there in place, which are currently being challenged before various high courts in the country. The government said that, well, we are not going to, as far as the earlier laws are concerned, we are not really going to say anything on that, let the courts decide that. But what they did was tweak around the indirect transfer rules to effectively say that if more than 50% of the value of a foreign company is derived from Indian assets, we are going to tax you in India. There were certain de minimis exceptions, which effectively provide that if you're holding less than 5% interest in the foreign company, in that situation, we are not really going to tax you. I think this has become pretty important from a formation perspective because we are seeing a lot of discussion, especially when you have LP interests which amount to 5% or more, as to even whether if in case of a secondary LP transfer, whether the indirect transfer rules also come into play. I think this is still a work in progress. The government has said that they're going to get in rules in place to further probably give clarity as far as these provisions are concerned. But at this point in time, what the government has essentially tried to do is to say, given clear indication as to what are the specific types of transactions as far as the indirect transfer tax provisions are concerned, which they're going to target. Again, when you look back, the ideal situation would have been for the government to actually remove these provisions, but I think politically that would have been a pretty tough ask. So I think that's the second area which is there. The third aspect which the government has also tried to address is relating to the presence of fund managers in India, because that's a long-standing ask which has been coming in from the industry to say that, well, you always have situations where even for an offshore fund, you want to have the ability to have the fund manager situated in India, and merely because the fund manager is there in India, there should not be a tax consequence for the fund in India. The government tried to address this. They tried to address this in last year's budget, didn't really succeed. They again sort of refined the rules to effectively say that, well, under certain circumstances, if you have a fund manager who's located in India, that is not going to give rise to a permanent establishment or a presence of the offshore fund in India to bring it within the Indian tax net. The challenge that I think all of us are grappling with is some of the conditions that are attached to it. In terms of the fund being a broad-based fund where you look at the entity level and don't really see as to whether it's a master feeder or what kind of structure you really have. And also there are certain requirements as to the quantum of corpus that you should maintain at any point in time. And there are a few other conditionalities which are posed, which sort of at this point in time, it may not really have an impact on all funds, but for a certain set of funds, I think it can still have a positive impact. And the ideal situation, obviously, is you want a blanket rule to say that, well, even if there's a fund manager in India, it doesn't matter because ultimately the income is still arising to an offshore entity. But still some way to go, but at least the start has been made in this year's budget. The fourth clarification, which again the budget tried to do, and this is something I'll take up in another session also, is really relating to foreign portfolio investors, at least in terms of certain kinds of investment which are made by portfolio investors. There has been a lot of debate in the recent past as to whether there is an applicability of what you call a minimum alternate tax for these portfolio investors. The government said that, well, we are going to clarify that at least from 1st of April 2015, as far as any investments or any gains which are realized by these investors, there's not really going to be a levy of this minimum alternate tax that is there. I think those are some of the key, what I would call takeaways, where you at least have a situation where the government has tried to address some of the specific concerns which has been raised by the industry. But having said that, as I said, you made a start, and the good bit is the government is saying, well, we are willing to listen to you to see what are the other changes that you require to see how much more we can tweak around with some of these regulations.
Mr. Just other interesting thing that has happened is the whole approach of Indian government is to reduce the level of tax. And, over a period of time now we'll have only 25% income tax on corporates. And the whole idea is to reduce tax concessions, but reduce the tax rate as well. And that's the new approach that's coming, which in long run seems to be right approach. There are some hiccups in between, that's expected. But I think that is another important development. It actually ultimately improves psychology of the investors that India is on the way to reducing taxes and streamlining its system. I think that's something one can make a note of.
Definitely, it's a receptive government, at least 4 to 5 steps whereby you've seen the government react directly to concerns by the private equity industry. So I think it makes sense to move to fund formation. Singapore, Mauritius, what are the key considerations?
Thanks, Kapil. I think, we've heard a lot of, this was a big concern for anybody investing into India as to, and looking at, India-focused entities, whether for fund formation or investments. Given the amount of noise there was the last 2 years around Mauritius and the Mauritius tax treaty, and whether that is going to survive the discussions that the previous government was having with the Mauritius government in terms of revamping the tax treaty to the concerns they had of round-tripping of Indian money through Mauritius, because of which a lot of investments coming through Mauritius were getting stuck for approval. And basically, if you had Mauritius in your structure, the concerns that most of the GPs were facing when they were looking at next round of fundraising from LPs is this going to create an issue for us in terms of more government scrutiny. And that's a very legitimate concern because, perception becomes as important as reality. One disclaimer, I think Nishit mentioned how he helped set up the Mauritius offshore financial center, but we also have an office in Singapore, so we are quite neutral in terms of both jurisdictions and servicing our clients from both jurisdictions. But we are very careful about when we are looking at Singapore versus Mauritius as a pooling vehicle or a vehicle to invest into India. I think the nature of the fund, the size of the fund, and where your LPs are coming from is extremely important. The two purposes you're serving are tax neutrality and tax certainty in terms of the tax treaty. There was a lot of question raised about the Mauritius tax treaty, which is still open in terms of discussions because the newspapers still report, and when we talk to people, they still report that the treaty is being negotiated between the governments to make it a little more robust. Most likely what is expected is a limitation of benefit clause being included, which should not be more harmful in our view or more stricter than what Singapore has. In the meantime, it's the tax treaty is still quite robust. We've for all our clients that are looking at investments that or raising funds less than $100 million, we do not necessarily suggest Singapore still because there is a cost involved in going to Singapore. It is firstly a real jurisdiction with very robust corporate laws and corporate governance. There is a cost involved of 200,000 Singapore dollars, which is not as easily, like you really have to plan out how to meet that cost. I mean, given that it is, if you have a presence in Singapore and you have people who are willing to move to Singapore, it's easy to meet that cost. Otherwise, it can be a real drag on your overall structure. Having said that, last few years, we still had clients willing to figure out ways to meet the expense requirement because there was just too much uncertainty and noise around Mauritius. That has died down significantly. And, even at that time, we were saying that Mauritius is, geopolitically very important for India. And just given the political relationships that are important between the two countries, the proof is in the fact that in the last few years, nothing has happened. Despite the level of noise around it, the treaty is still as it was. And even though, negotiations are still going on, we have certain amount of comfort that the basic benefits of the treaty are not going to go away simply because it's so important to India and Mauritius. Significant of Mauritius revenues come from there. So from certainty perspective, I think Mauritius is still good, depending on your size and the setup of your organization in terms of having presence in Singapore and the costs involved in establishing in Singapore. I think we advise clients based on these factors rather than blanket Singapore or blanket Mauritius. I think in terms of tax neutrality, both jurisdictions work really well. But again, when we are structuring from Singapore, we advise our clients on Singapore governance regime and the corporate laws there to look at how you're going to then get money out of the country. Because it's not, if you're setting up as a company in Singapore, you have to ensure that you've met the corporate law requirements there in terms of meeting the solvency tests or various other requirements for presence in Singapore, and in certain cases being regulated by the MAS in Singapore if you cross certain thresholds, which are all considerations to keep in mind when you're looking at Singapore.
I'll just add a couple of things. Pratibha made excellent points actually on Mauritius versus Singapore. As far as Mauritius is concerned, as she mentioned, we have excellent political ties and also historical ties because 60% of the population is of Indian ethnic origin there. And interestingly, Mauritius also has attraction for India in terms of its subsea wealth. If some of you know how Mauritius is, there are a number of islands. So if you look at its continental shelf, the coastline in that sense, is almost 1/3 that of India, even though it looks like a tiny island. And because maybe there are 200 islands, but each one gets 200 nautical miles. And so it's a huge economic subsea wealth that Mauritius has. India has interest in exploration of that as well. And that's another reason. One more thing I may mention, that sometimes we think that limitation of benefit article is bad, it's all this thing coming up. But it might also have upside in the sense that, on the GAR, of course, at the moment GAR has been postponed, but the GAR guidelines, which are proposed, say that if there exists a limitation of benefit article in a treaty, then GAR will not apply, because that itself takes care of the limitation. So that's an interesting point to note as well. And it's unlikely that India will terminate treaty with Singapore because of its political, economic, historical other ties, and to withdraw from a treaty doesn't reflect good on the relationship between the two countries. So that's one point. On the Singapore side, Singapore is perceived very well generally, and therefore people feel comfortable. It's easier to establish substance because you can easily migrate to Singapore. And number three, that when it comes to hedge funds or some of those kind of funds, how do you comply with the limitation of treaty benefit article? Because if you're selling and buying every morning, you know. One of the problems is that in order to get capital gains tax exemption, you must have spent Singapore dollars 200,000 in 2 years prior to the sale of the shares. Now, you don't have history, you know. So first 2 years, what do you do? You know, some of those questions come up. And as Pratibha mentioned, corporate laws are still slightly behind the modern corporate laws in many other countries. So redemption of shares except out of profits or the reserves is a little difficult. And therefore, if you set up a company, then you have that problem. How do you return money when you have not made a profit? Assume you made a loss. Okay, how do you return money to the investors? Second thing, that somebody would say, okay, we'll set a business trust in Singapore, so we don't have a problem on that. But trust may not be eligible for treaty benefit because it would be a look-through. And then the tax department will not allow benefits to a trust structure in Singapore. So that's another challenge. So typically you will see most of the structures would have a trust on the top to collect money, and then you invest in the Singapore company, and then Singapore company invest in India. So these are some of the niceties of the two jurisdictions. And I
We
hope
actually have two live situations. One where the entity was set up 3 years ago, and they hope to meet the LOB requirement, but now are not able to exit because they've not been able to expend the 200,000. So you really need that plan to be in place. You know, they thought, oh, exit in 4 or 5 years, we'll consider. And then, you know, a good opportunity came, markets had turned, you know, it was a good time to exit, and they're not going to get the benefit because of this particular requirement. And then we have another situation where there is solvency in the entity, but one of the directors is not willing to give a solvency certificate, and without all directors giving the solvency certificate, you can't make an exit. So even though they've got a good exit from India, how to, you know, provide the money then to the investors out of Singapore is becoming a concern. So these are things that you have to think through before you, you know, choose either jurisdiction.
So clearly, there are benefits to both. Perhaps Mauritius piping Singapore just slightly. But if we were to just take a step back from a practitioner's standpoint, and something that's probably very relevant to a lot of people in this room, Will, if we could ask your thoughts on what are the key issues discussed in sort of LPGP negotiations?
Well, I would say the major discussion is why can't you cut your fee and carry, which I guess is inevitable. But once we get past sort of the raw economics, the discussions from the negotiation of the legal points become much less important. There's concern about the amount of equity that the managers invest alongside in the fund. And generally, the important issues are generally those kind of economic issues. In evaluating the funds and during the due diligence, the LPs spend, and we have, I think, 100 LPs in our newest fund, of which probably 15 or 20 are have significant presence globally in the investment space, and therefore have the resources to send 5 people over to spend 2 days with us to understand how our business operates. So that probably that kind of due diligence, or who our investors are, how our process works, how we make investment decisions, what industries we like and why, how we did previous deals. That probably occupies the bulk of the interaction that the fund, the GP, has with prospective LPs.
Can I just ask a follow-up question in terms of, you know, over-regulation of funds globally and fundraising process? You know, how painful has that been for you? Or, you know, for example, dealing with AIFMD regulations, or, you know, the SEC regulations keep changing right now in the US in terms of, you know, offer. So is that, and how costly is that?
Well, there's sort of 2 sets of problems that have different answers. many funds try to market the LP interest themselves, and after you reach a very small scale, that's just not practical. So we've always appointed an advisor who's a licensed broker in all of the relevant territories to manage the offering process for us. So UBS has traditionally done that for us. When you go to the U.S., many of the states have provisions where the broker who places the interest in that state with the pension fund can't receive any commission on that, and there are very onerous documentation requirements around that. So it's actually quite a specialized area, and unless you have 15 people in your investment relations department, you probably don't want to do that yourself. So that's sort of one set of problems that has a fairly simple solution of paying away a fee to get a placement agent. The other area is AIFMD, which is frankly a nightmare for us. We're still in the transition phase where local private placement regimes apply. We have reverse solicitation rules that apply elsewhere, although we have to be very careful that it's truly a reverse solicitation. When the transition regime expires, it's not at all clear whether, the discussion of how a non-EU manager gets a passport is still very much undecided. So that's going to be a big challenge.
I think I'd like to add, it's quite interesting. HarborVest has taken a completely different approach where we have actually registered a funds. This has allowed us to market freely throughout Europe using the passporting legislation that has come through. But we've always, not to say we have a 15-man investor relation team, but there are quite a few heads, and the rest of us sort of chime in. We have always taken it upon ourselves to market our own products on the basis that we understand them better than any outsourced provider. And in that sense, we are regulation heavy. We were one of the first private equity fund of funds to register with the SEC in the US almost 3 decades ago. In Hong Kong, SFC regulated. In places like Korea and Japan, we make it a point to register our funds before we go on shore and market. And it's true that reverse solicitation is becoming the sort of de facto option, but it is very, very important that that isn't abused. Marketing has also really been impacted by KYC and AML legislation that's come about across the world, and I think it's become, whether it's the UK Bribery Act, whether it's the Hong Kong Anti-Money Laundering Ordinance, and all the provisions in the States and other jurisdictions, the regulatory burden on marketing has meant that cost-effective structures have to be put in place so that they are managed appropriately. There is no end in sight in terms of regulatory oversight for funds, whether in India or other parts of Asia. Richie, I feel like I've left you out there on a limb for a bit. If I could pull you back in and ask, on the back of what Will discussed, what are the key issues driving alignment between LP and GP relationships?
Sure. Thanks, Kapil. I think the first cut of the term sheet where we offer fund terms for the GP to share with the potential LPs, I think we cut it from a cloth which is, as broad-based to address all the different kinds of LPs that the GP would potentially like to meet for his fundraise. What has happened is, like, William indicated, there has been the first round itself is the headwinds on the management fee. There has been a lot of resistance, especially if, let's say, you are a Series 1, GP who's raising a first-time fund. A lot of pressure where, LPs would sort of seek that, okay, can you give us preferential terms? Even though the size of the commitment could be less than what you would expect from an initial sponsor or anchor investor. A lot of pressure there. But here again, like, William and Kapil also indicated, there has been overabundance of regulations on investment funds globally. Taking tax just in example of, EEA, European jurisdictions. What has happened is, especially if you're a non-EU fund manager, you have to opt into the AIFMD, Alternate Investment Fund Managers Directive, as opposed to, a European-based manager who is allowed to freely market a product there. While the rules for EU-based fund managers are still being crystallized, what we have seen is, A, the LPs, to begin with, they are sensitive. they understand that they should, to put the reverse solicitation in some more of a concrete form, they themselves, give a written invitation to the GP, or, just say that, okay, let me write an email to the GP, to you, and based on that, you give me a response on, what are the documents you want to share with me on track record, etc. So a lot of, sophistication with the LP also, who are quite sensitive to the pressures that the GP is facing. But what that also means is that unlike, the traditional day where a sophisticated investor would have, just checked the box on, okay, are all the compliances being met or not? Today, there is a requirement, or, there's an expectation that there should be a general culture of day-to-day compliance that a GP should meet. All this adds to the pressure on the management fee. So it's not just, about retaining talent for the different strategies for which you're raising the commitment, but also to meet the compliance, you as a GP are able to sort of justify the kind of management fee that you are sort of putting it out there for the LPs to appreciate. Of course, we see a lot of variations in the market on this. There could be, it could be on the basis of, the actual bills that you run up on an annual basis. You do a very tangible, reasonable bifurcation between what could be the expense for the fund bucket and what could be an expense for the fund manager itself to bear out of the 2%. The 2% continues to be a percentage of commitment, commensurate with the effort that the GP is trying to source different deals to fit on that strategy. But when it gets interesting is post the commitment period. Traditionally, it has been a function of, perhaps the costs of investments, which are still out there in the fund's portfolio. But increasingly, you see a shift towards fair market value, whatever is lower between the cost of investment or the fair market value. Again, something which has been driven by the LPs based on what was recommended by Institutional LP Association, ILPA. So again, you see some of the GPs trying to differentiate their offering by suggesting terms which are more LP friendly, but at the same time not appearing to be weak. Because if you are too defensive in the fee or the carry allocation programs that you're offering to the fund, the LPs may take it as a sign of weakness, and perhaps there could be compromises made. Sometimes, again, we traditionally see a combination of side letters, but if you're, again, offering too much of a bespoke structure, going not just into the fund economic terms, but also non-economic terms, we would rather see a multi-class structure with a very defined right to a particular class, as opposed to, differentiating between LPs of the same class, basically using a side letter in that scenario. So a lot of variations out there in the market.
Certainly, yeah. Are there any questions from the floor, incidentally, on any of the topics we've discussed? Okay. Well, Rajesh, then, if we turn to carry allocation, are there any tax concerns related to carry allocation structures?
I think when you talk about carry today, there has been a lot of churn in the Indian market in terms of the regulations which sort of look at carry, especially in situations where, let's say, whether it's a global fund having the employees of the managers or the advisors in India, or even if it's an India-focused fund where you're trying to see, okay, how do I best structure for the carried interest for the Indian employees. And you have multiple set of regulations which really come into place. The first one is really from an exchange control perspective, because India still is one of those jurisdictions which have some limitations as far as exchange control is concerned. And there are restrictions as far as Indian individuals or Indian employees holding interests abroad. And the second aspect is also from a tax perspective, because we don't really have well-defined rules which govern as to how really a carry interest is going to be taxed. Traditionally, you always had a situation where if you had India-based managers, they used to have their own offshore personal holding companies or trust structures, which actually invested and got, whether it's on co-investment on carry, actually got the carry units. One of the things that really happened in this particular budget was that the government essentially wanted to clamp down in respect of individuals having what you would call illegal money outside of India, or black money, that's the common parlance that's used in India. And they brought in, or they have proposed some wide legislation in order to curb those practices, which incidentally have also an impact as far as a lot of fund managers are concerned. Effectively, what they have said is that, well, if you have any offshore assets, we want you to disclose that in India, and this goes through multiple layers, irrespective of what's the kind of structure that you have. And there are some pretty stringent penalties as far as non-disclosure or non-compliance is concerned, including having potential criminal penalties. So I think from an Indian manager's perspective or an Indian employee's perspective who has carry units in an offshore fund, I think structuring is becoming increasingly critical, because the standard question that you really get is that why can't I hold the carry units directly? And the issue there is more of a permanent establishment or residency related issues, where you have potential situation where the fund itself, because it's usually set up as a partnership entity, can be considered to be a resident of India, even if a fraction of the control and management is in India. So we usually advise the funds that the employee should not be holding direct units, whether in the GP entity or in the fund entity in any form or manner, to avoid any Indian tax consequence. But you need to sort of realign that along with the Indian employee's position, where any use of a complex structure or a personal holding structure can result in potential disclosure and other related consequences. And also, I think the second important change was also when we talk about the use of personal holding companies, where the budget also brought in rules relating to the place of effective management, to effectively say that a foreign company would be considered to be a resident of India if the place of effective management was in India. Traditionally, the rules relating to residence provided that a foreign company would be treated as a resident of India if the whole of the control and management was in India. So which is why it was always possible for you to have, let's say, a personal holding company actually hold the carry units, and as long as the distribution didn't happen, there was no tax consequence in India. And you could also ensure that the distributions were, the characterization of the distribution was either in the form of a capital gain or dividend, depending on how the employee really wanted it. But with the introduction of the place of effective management rules, effectively, even if you have a personal holding company outside of India, even that would effectively now be considered to be a resident of India. So which means that any distribution which is happening from the fund would effectively be taxed in the hands of the employee in India. So I think those are some of the rules which sort of right now impact as far as any carry structuring for managers or advisors or employees situated in India. So that's one part of, I think, one part of the whole structure, which has become a bit more complicated in the recent past. While the government has eased out some of the rules on some aspects, I think this is one aspect which has actually gotten a lot more complicated now.
Thank you. Well, I guess in the last few minutes that we have for this session, it's, if we were to summarize briefly, there's an incredible sense of optimism. There is realistic change happening in India. There is a budget that was put forward that was practical, didn't overstep its boundaries in terms of what it could promise, but there's definitely a sense that there's more to come. A bankruptcy code is going to be introduced. There's a regulatory reform bill being proposed. There's still a lot on the table that will generate a lot of interest in India and really enhance the private equity environment. So that begs the question, and perhaps I can turn to Will. Would you consider an India-focused fund? Is this the right time?
I mean, the short answer is no, because we don't do any country funds. So, I mean, we have an overall strategy of being a regional player with the ability to allocate our investments between different countries depending on where they are in the economic cycle and where the valuation is. But I can definitely see the case if a fund manager who was willing to have a country strategy, I think this might well be the right time to do that.
Sure. So if maybe we could take a poll in the room, if people think now is the right time to look to an India fund, those in favor? You have a lot of work to do. And we'll take it as the rest of you are just undecided, and we'll probably raise your hands by the end of the day. Well, thank you. Are there any other questions?
Oh, yeah.
Sure.
Oh, good.
This may or may not be germane
Can you
to the panel. Oh, I'm Joel
can you
Lakin,
introduce yourself
Secretary
and then
General
Can you
Oh, I'm
introduce
sorry,
yourself?
Am I on
Yeah,
or
yeah.
someone else?
You're on.
You're on.
Okay, good, sorry. A lot of people in the room, many questions, I'm sure. I'm Joel Lakin, Secretary General of the IPPF, and I was framing out this question in the area of carbon, and you may have already touched on it because I came late to this session, and I apologize. But there seems to be a renaissance in both Europe, certain parts of the Americas, and in China, driven possibly by the agreements between President Xi of China and Obama about climate change and all that. Is there much development now or renewed interest in carbon credits as a revenue stream for industries in India like energy, power, cement, coal-related industries that produce huge amounts of CO2? Just curious. And is there a development, renewed development in carbon funds? That was my question.
Well, Rajesh, you should chime in, but my short answer is, it was a few years ago that the discussions had started. When it became a global trend, India wasn't far behind in terms of at least having the discussions, but we haven't seen anything concrete actually coming through.
And to probably answer the question a different way is that even for funds which are looking at investing in renewable companies, they don't really look at carbon credits as a revenue stream still, even when they're doing their models, because I still don't think it's really picked up. Yes, there was a market a few years back. I think it's pretty much crashed right now. So I don't think it's more of an ancillary aspect that people look at rather than being the core.
Yeah, John Levak.
John Levak, HKBCA. A question for
Can you be a
Rajesh.
little louder?
Yes, sorry. Rajesh, you gave a very good explanation on the tax on carry for Indian resident employees. Focusing on non-Indian resident employees and looking at the consequences, particularly in Singapore, where you are supposed to bring your fund entity and management together in one jurisdiction. What is the Singapore position with regard to tax on carried interest?
So let me answer, again, I'm not the expert on Singapore laws, but I'll tell you globally when you look at it, the challenge that's there, I think starting with the US as to what is the characterization of carry units, whether you want to treat it as capital gains or whether you want to treat it as employment-related income. I think that's a debate which has still not been settled. You've had cases which have come in from Europe, which have looked at it potentially as capital gains, but is there a clear-cut answer to that at this point in time? I don't think any particular jurisdiction has actually taken the call one way or the other, though there is a lot of debate that is happening. In fact, even in India, we expect that debate to start off sometime soon because that's not really been picked up. I think it's still going to be a developing issue because today it's easy to argue that it is capital gains because you're still ultimately, there is really a return as far as your investments are concerned, however little or however high it is. But having said that, will you have situations where tax authorities in multiple jurisdictions want to treat it as salary or employment income? The answer is yes. I think over a period of time, you're going to have more challenges on that coming through, where the courts in multiple jurisdictions are going to be tested on this particular issue. So I think we are still a few years away from really having a clear-cut answer that it will always be capital gains. And in fact, that is one reason why traditionally we've always tried to structure it through a personal holding company, because you would try and remove away the ambiguity by ensuring that the characterization is a return from the company rather than you having a return from the fund. So that was also in fact one of the reasons why we had the PHC structures in place. But today I think you're still a few years away from having a clear answer saying that it is going to be capital gains.
Yeah, and I think I'll just like to add that increasingly you also see there is a level of disengagement between, let's say, the fund pooling vehicle where the LPs are participating and the carry pooling vehicle. Of course, the carry pooling vehicle, if you are an institutional GP with, let's say, a different multiple geographical focus, etc., where the GP members who are entitled to or they are entitled to the carry, they could be from various geographies, you would sort of put it in a different vehicle where you would want to add that much level of substance that you can always demonstrate that what you got was an allocation of disproportionate return as opposed to something which is more aligned with, let's say, the business income of the manager or the revenue returns, etc. So I think there is some amount of debate which can be built in. There's some amount of defense also which can be built in on how you structure the entire carry allocation program.
But essentially, if you were advising a client to establish a Singapore fund with a manager in Singapore, you would say there's uncertainty on whether you'll be taxed on carry there.
Your ideal situation is capital gains, as always. But it is still uncertain.
Thank you. Any other questions? All right, well, thank you, Mr. Desai, Will, Prabhata, Rajesh, and Richie, and thank you all.
Thank you, Kapil, for moderating the session.